If you think successful investing requires 6 monitors, a caffeine addiction, and screaming at a chart at 4 a.m., you have been played. The financial industry spends billions of dollars every year to convince you that activity equals productivity. They want you trading, tinkering, and stressing. They want you to believe that the stock market is a complex puzzle that only the hyperactive can solve. Why? Because every time you move your money, they get paid. Every time you buy, sell, swap, or optimize, a bank takes a slice. They are the casino, and you are the guy at the slot machine pulling the lever hoping for 3 cherries. I used to be that guy. I thought I could outsmart the market. I thought, I'm a smart guy, I read the news, I know what's going on, therefore I can pick the winners. But after looking at the math, I realized the most profitable strategy I ever deployed wasn't a killer trade. It wasn't a lucky crypto bet. It was a nap. This is the do-nothing strategy. It is the art of aggressive laziness. And today, I'm going to show you why doing absolutely nothing is the only way to beat Wall Street at its own game. Let's start with the active trading trap. In 2026, we are surrounded by noise. Your phone buzzes with notifications. Stock X is down 5%. Crypto Y is mooning. The Fed is raising rates. It triggers your fight or flight response. You feel like you have to do something. You feel like if you aren't reacting, you're losing. I remember my early days of investing. I treated the stock market like a video game. I bought the hot tech stocks because my neighbor told me to. I sold them 3 weeks later because I got scared. I was chasing the green and running from the red. I felt productive. I felt like a trader. I would tell my friends, yeah, I'm moving some positions around. It sounded sophisticated. But then tax season came. I looked at my actual returns. After you factored in the short-term capital gains taxes, which are brutal, and the trading fees and the bid-ask spreads, I had made less money than if I had just put the cash in a jar under my bed. I was picking up pennies in front of a steamroller. Here is the reality of 2026. You are not competing against other people. You are competing against algorithms. You are competing against artificial intelligence that can read every news article, analyze every balance sheet, and execute a trade in a microsecond. Do you really think you, with your slow human brain and your spotty Wi-Fi, can beat a supercomputer? It is arrogance, and the market loves to punish arrogance. So if you can't beat them, what do? You stop playing their game. You switch to a game they can't win. You switch to the long game. This brings us to the core of the do-nothing portfolio, the S&P 500. You have probably heard of it, but most people don't understand what it actually is. They think it's just a stock. The S&P 500 is a list of the 500 largest, most profitable, most dominant companies in the United States. We are talking about Apple, Microsoft, Amazon, Google, the companies that literally run the world. When you buy an S&P 500 index fund, you are not betting on a single horse. You're betting on the racetrack. You are betting on the American economy. And here's the magic part. It is self-cleansing. This is the part active traders miss. They try to pick the winner, but the S&P 500 does that for you automatically. If a company starts to fail, let's say it's the next blockbuster video, it shrinks. Eventually, it gets kicked out of the index. And who replaces it? The next Netflix, the next big innovator. You don't have to guess. The index automatically sells the losers and buys the winners for you. It is the ultimate survival of the fittest machine. And what is the return on this machine? Historically, over the last 100 years, the S&P 500 has returned an average of about 10% per year. Now, 10% doesn't sound sexy. It's not the 1000% gains you see on those scammy YouTube ads. It's boring. But let's look at the math of boring. If you invest $500 a month into this boring index fund, and you do it for 30 years, assuming that 10% average return, do you know what you have? You have nearly $1 million, specifically around $986,000. And how much of that was your actual money? Only $180,000. The rest, over $800,000, is free money. It is compound interest. It is the market paying you for doing nothing. But wait, it gets better. Or worse, depending on how you look at it. Let's talk about the smart money. There are people who get paid millions of dollars a year to manage mutual funds. These are the guys in the custom suits. They have teams of analysts from Harvard and Yale. They have access to information you will never see. Their entire job is to beat the S&P 500. That is the benchmark. If they beat it, they're heroes. So how did they do? Over a 15-year period, nearly 90% of active fund managers fail to beat the market. Let me repeat that because it is insane. 90% of the professionals lose to the do-nothing strategy. Why? Because they are human. They get scared. They sell at the bottom. They get greedy. They buy at the top. And they charge high fees. If a fund manager charges you a 1% fee, that sounds small, but over 30 years, that 1% fee can eat up 25 to 30% of your total wealth. The do-nothing portfolio uses low-cost index funds or ETFs. The fees are practically zero. You keep your money. So if the math is so clear, why doesn't everyone do it? Because doing nothing is psychologically incredibly difficult. It is easy to do nothing when the market is going up. Everyone is a genius in a bull market. You look at your account, it's green, you feel smart. But then the storm comes. I remember 2008. I remember 2020. The market tanked. The headlines were screaming the end of capitalism, market collapse, sell everything. Your portfolio drops 20% in a week. You see thousands of dollars vanishing. Every instinct in your body screams, do something, stop the bleeding, sell now and buy back in when it's safe. This is the moment that separates the wealthy from the broke. If you sell, you lock in the loss. You turn a paper cut into a fatal wound. And the idea that you will buy back in when it's safe, that is a myth. By the time it feels safe again, the market has already recovered. You missed the bounce. I remember staring at my screen during a crash. My finger was hovering over the sell button. I was sweating. I wanted the pain to stop, but I forced myself to walk away. I closed the laptop. I went for a walk. I did nothing. And because I did nothing, I captured the entire recovery. There was a famous internal study done by Fidelity, one of the biggest brokers in the world. They looked at their accounts to see which customers had the absolute best performance over a long period. Do you know what group of people had the best returns? It wasn't the day traders. It wasn't the hedge funds. It was the accounts of people who had died. Dead people. Why? Because dead people don't panic sell. Dead people don't try to time the market. Dead people don't read the news. They literally do nothing. Now, I am not suggesting you die to get rich, but you should invest like you are dead. So how do you actually implement this? How do you build the do-nothing portfolio? It is surprisingly simple, but you have to set it up correctly. Step 1 is the vehicle. You need a brokerage account. Fidelity, Vanguard, Schwab, it doesn't matter. Just pick a reputable one. Step 2 is the asset. You want a total market index fund or an S&P 500 ETF. Look for ticker symbols like VOO, IVV, or SPY. Or if you want the total market, VTI. You are looking for an expense ratio below 0.10%. If it's higher than that, you are paying for someone's yacht. Step 3 is the automation. We talked about paying yourself first. This is where that money goes. You set up an automatic transfer every single month. The money leaves your bank, hits the brokerage, and automatically buys the fund. You do not try to time it. You don't say, "Oh, the market looks high, I'll wait." You don't say, "Oh, it looks low, I'll wait for it to go lower." You just buy. Every month, rain or shine, high or low. This is called dollar cost averaging. When the market is high, your $500 buys fewer shares. When the market is low, your $500 buys more shares. You automatically buy more when it's on sale. Step 4 is the hardest part. You delete the app. I'm serious. If you have the trading app on your home screen next to Instagram and TikTok, you are going to check it. And if you check it, you are going to tinker. Your portfolio is like a bar of soap. The more you handle it, the smaller it gets. Check it once a year, maybe twice. Rebalance if you need to, but otherwise, leave it alone. This strategy is not for the gambler. It is not for the person who needs excitement. If you want excitement, go to Vegas. Put it all on red. That is fun. You get free drinks. But your life savings is not for fun. It is for freedom. Real investing is boring. It should be as exciting as watching paint dry or watching grass grow. If you are having fun investing, you're probably losing money. The do-nothing strategy is the ultimate rebellion against the financial system. The system wants you active. They want you scared. They want you paying fees. By doing nothing, you are opting out of their game. You are saying, "I don't need to be smarter than the market. I just need to be more patient than you." And in 2026, patience is the rarest asset on the planet. Everyone wants the quick win. Everyone wants the 100x return overnight. Therefore, everyone is broke. Be the boring one. Be the lazy one. Be the one who wakes up in 20 years, looks at their account, and sees a number with 2 commas in it, all because they had the discipline to sit on their hands. So here is your challenge for today. If you are currently picking stocks, if you are currently paying a 1% fee to a guy named Chad to manage your money, or if you are sitting in cash because you are waiting for the crash, stop. Look at the math. Look at the history. Open an account, buy the index, set up the auto pay, and then go live your life. Go fishing, play with your kids, work on your career, do literally anything other than staring at a stock chart. Your money will work harder than you ever could. Let it. I have a video about the exact index funds I use, the ones with the lowest fees and the best track records. I'm not selling them. I just want you to buy the right ones so you don't get ripped off. Click right here. Let's get to work.